Hey, what's happening, future certified public accountants? Peter Linto back with you. Very important topic for you personally, and I'm talking to you. It's called a discontinued operation. What's an example of a discontinued operation? You going out and having a good time with your friends while you're trying to study for the CPA exam. That needs to be a discontinued operation if you're serious about passing this exam, okay? Now, insofar as how this is tested on the CPA exam, what are discontinued operations all about? Well, step number one is, where does this get reported on the income statement? It's way at the bottom. Discontinued operations are reported after your income from continuing operations, which is the sum of two separate components, which we'll review in a second. It's reported way at the bottom of the income statement, just before net income. Whenever you see discontinued operation, yeah, you think about not going out with your friends, but you also think net of tax. All right, continuing operations. Remember, that's the sum of two categories. Your operating income, most of your revenues and expenses, as well as your non-operating, your gains and losses. Remember, your income or loss from operations, your operating income, includes, well, your revenue, what it is you do all day, every day, selling your goods and services, as well as those operating expenses that you incur all day, every day to generate those revenues. So your cost of goods sold, SG&A, depreciation, R&D, all that kind of stuff. Now, most revenues and expenses, when you see that, you're thinking, hey, that's probably part of my core business. But there are certain revenues and expenses where they might call it other. Or if you're a non-bank, don't forget the interest revenue, interest expense. That's all non-operating if you're not a bank. So if they call it other revenues, other expenses, or the interest revenue, interest expense, and you're not a bank, you're thinking that's other. And then the big category for the non-operating, when we sell off non-inventory, sell off investments in other companies, or sell PP&E, whatever it may be. That's unusual and or infrequent. You're thinking, hey, that's gain or loss. So we've got our operating income, category number one, the non-operating, category number two, and then the sum of those two categories, well, that gets us our income or loss from our continuing operations. All of that is likely to recur in the future, some things more than others. But then below the income from continuing operations, that's where we have what? The discontinued operation, and that's reported how again? Net of tax. Beautiful. So when do you need to be on the lookout for a discontinued operation? Well, one of two things is going to happen on the exam. Either that segment of the business, a major segment of the business, think of a product line or maybe a geographic area, but a major segment of the business, we actually sold, disposed of that particular year, or we haven't found a buyer yet, but the board has said, listen, we're selling off this segment, so then it's classified as what we call held for sale. Now look, if we're reporting our results from operations, let's say for 2022, I don't care if they sold it in January or November. All of the results for that year are going to be under the heading discontinued operations, regardless of the particular date where they actually disposed of it. Or let's say they haven't even found a buyer yet. They've merely classified it as held for sale that year. Let's say they're on a calendar year basis. I don't care if they classified it as held for sale in March or December. If they classified it as held for sale in that particular year, 2023, then you know what? All of the results of operations for that year, regardless of the particular month where they adopted the plan, all the results of operations for that segment are going to be reported where? Discontinued operation, way down below net of tax. Okay, now the accounting rules. So first of all, look for a fact pattern on the exam where we have a strategic shift in the business, a major effect on the entity's operations because they've decided, you know what? We're no longer going to sell goods or services in this geographic area. We're getting out of Europe, or we're getting out of North America, whatever it may be. Or they have a disposal of a major equity investment. Remember what an equity investment is? Where you have significant influence over another company. You own at least 20, but not more than 50%. You're not consolidating. Okay, you use that equity method of accounting. That might be an example where we have that strategic shift. Or the easiest to identify, we're selling off a major product line, a line of our business we're getting rid of. That would be that strategic shift that has a major effect on the entity's operations and financial results. This is going to significantly, when we get rid of this, this is going to change our total revenues and expenses or whatever it may be. So that would be your cue on the exam. You got to think about the discontinued operation rules. Okay, now the types of calculations you might have to do in one of these problems. Number one, we need to know if let's say they've decided to sell the business in June, okay? And now we're at December 31st. They decided to sell the business in June. Well, all the results of operations for that particular product line or that geographic area that we're discontinuing, we've got to calculate the gain or loss on operations. We haven't sold it yet. So all the revenues and expenses for that product line now have to be separately reported under the heading discontinued operation, but for that period only. So even though we adopted the plan in July, if I'm doing my calendar year income statement December 31st, all my results of operations from January through December are going to be moved down below, and it'll be gain or loss on operations, okay, for this discontinued operation. Second thing we got to look for is, did we actually sell it that particular period? So again, if they sell it, I don't care if they sell it in February or July, it doesn't matter. Whenever they sell it, you're going to do a calculation. Well, what was the selling price versus what was the carrying value at the time of sale? That gain or loss on disposal will be reported under the heading discontinued operations. Now, we don't estimate what's going to happen in the future here. We wait. So the results of operations are not estimated. We're looking back. It's December 31st. What was the results of operations, the revenues and expenses for that discontinued segment? Or we actually sold it. Okay, selling price versus the carrying value. There's our gain or loss on disposal. The third thing we're going to have to calculate is what's called the impairment loss and possibly a subsequent increase in value. But let me explain how an impairment loss works. The board decides in February, we got to discontinue segment A. We got to discontinue it. Once they adopt this plan, now that it's held out for sale, what the board has to do is in good faith figure out, okay, what do we think our net realizable value is going to be on this sale? Okay, what's our net realizable value versus what's the book value for this product line, this segment of our business? Now, the rule of conservatism, once you hold this item for sale, you can no longer sit on an unrealized loss. So if you've determined, hey, the net realizable value is 1,000, but you know what? We've got the book value at 2,000. You can't, in good faith, leave this product line, this segment sitting at 2,000. You'd have to write it down to 1,000. So that's part of that rule of conservatism. You think you're going to have a loss, we're going to write it down immediately. Now that impairment loss, because it's related to a segment we're selling off, is going to go under the heading discontinued operation, that category number 3, not number 2. There are other impairments that would go in category number 2. The impairment, when you know you're selling off a segment, that goes under the discontinued operation. So let me give you a little example how the impairment loss calculation might work. Let's say we've decided to hold out this product line or this geographic area. We're gonna sell it. We haven't sold it yet, but we plan on, they've adopted the plan, the board has to sell it. Let's say the book value is 10 for argument's sake. Step number 1, I've got to calculate the net realizable value. What you think you can sell it for minus the selling cost, that's the net realizable value, because chances are you're going to have to hire a third party, a broker, to find you a buyer, and they're going to want to get paid. So the book value, carrying value is 10. We've got a selling price. We think we can sell it. The market value we think is 9, but we're going to have cost to sell it of, let's say, 1. Step number 1, we take what we think our selling price would be, the market value, minus our cost to sell. We get our net realizable value. That's 8. Okay, step number 2. The lower of the net realizable value or the book value, that's what we need to have on the books now, rule of conservatism. So the net realizable value is only 8. We've got a carrying value, a book value of 10. We're immediately going to record an impairment loss, and that impairment loss is 2. Now, obviously, there's a lot of management bias there because we're estimating these items, but we have to do it. So the net realizable value is only 8. Carrying value 10, we write it down to 8. Now the carrying value is 8. Okay, what if in the next year, we still haven't found a single buyer, but all of a sudden there's a bidding war? And now because of this bidding war, there's an increase in what we think the market value is. So let's say the proposed selling price now goes all the way up to 12. The cost to sell is still 1. So now the net realizable value is 11. And you're saying, okay, Pete, the next year, the net realizable value is 11. We wrote it down from 10 to 8. So the book value, carrying value now is 8. We're going to write it all the way back up to 11. Wrong. Although you're right, net realizable value of 11 minus the carrying value of 8, although that gain, so to speak, that mathematical gain is 3, there's a cap when you reverse that impairment loss. you can't write it up by more than you wrote it down. So we wrote it down by 2. We wrote it down from 10 to 8. Can you write it all the way back up to 11? No. You can only write it up to how much in a subsequent period? You can only write it up to 2. So I'll give you more examples you'll see. But subsequent increases in value, if you have that, remember, when you reverse that impairment loss, you can't reverse more than the original write-down. That's kind of the cap on that gain, okay? And you'll see how that works as we work a lot of examples here. Okay, now, in the period disposed of, sometimes it's an easy fact pattern where in year 1 they adopt the plan to sell it, and they actually sell it in year 1. That's an easier fact pattern. More complex, multi-years. Maybe in year number 1, they hold it out for sale. The board adopts the plan to sell it, but by the end of that calendar year or fiscal year, whatever the case may be, they haven't found a buyer yet. All right, so then we're going to have multiple years of discontinued operations for that segment, as you're going to see. So 3 things we're going to look to calculate. Once we hold it for sale, once we make that decision, is there an impairment loss? Because we're going to have to write it down, right? Rule of conservatism. The results of operations, if it's a calendar year company, regardless of when the plan was adopted during that calendar year, from January 1 to December 31st, the results of operations are moved down below because that's going to be discontinued. You don't report the gain or loss on sale, though, until it happens, okay? Everything gets reported in the period in which they occur. Now, is there any longer a need to depreciate or amortize the assets within that segment once you hold it out for sale? And the answer is no. Depreciation amortization stops. Once management has decided to dispose of that component, we no longer depreciate or amortize the assets within that segment, okay? That stops. So no more depreciation or amortization. Okay, now measurement and valuation. I'll give you another example. So the board has decided we're going to sell off this segment. It's classified as held for sale. Question number 1 could be a theory question. How is that segment now reported on the balance sheet? It's going to be reported at what? The lower of the net realizable value or the book value, okay? So let's say I make the book value in this new example 9. Let's say the net realizable value, well, let's say the fair value, we think we can sell it for 7, but hey, the broker is going to charge us 2 to help us find a buyer. So we've got the book value of 9. Now, how do we calculate the net realizable value? It's your fair market value minus your cost to sell. So in that example I just gave you, with a fair market value of 7 and cost to sell of 2, the net realizable value would be 5. So you're sitting on an unrealized loss. Rule of conservatism, once we hold it for sale, you can't keep it at the 9. We're going to have to write it down from 9 to 5. We would have an impairment loss in the year we hold it out for sale. And now the carrying value would go from that original book value of 9, it would now drop to 5. If we have a subsequent increase in fair market value, you can go ahead and record a subsequent increase in fair market value, but you can't report a gain of more than what amount? 5. Since you wrote it down from 9 to 5 and you recorded an impairment loss of 4, if there's a bidding war and now all of a sudden we write it back up, you can't write it back up and have a gain of more than 4, okay? So the carrying value can be written back up from 5. If it goes all the way up to 30, you can't write it from 5 to 30. The maximum book value would be 9. You can't write it above that. And again, that's part of that rule of conservatism. Okay, now where do we present this? Again, discontinued operations, category number 3, bottom of the income statement, right after income from continuing operations after tax. Then comes your discontinued operations heading, colon, and you'll see the different things that are reported all net of tax, and then we have net income. We've got to disclose now, either on the face of the financial statements or the notes, we need to know. What product line was this? When management's going to be discussing this a little bit about what happened, why we're selling off this segment, how we think this might affect the business going further, etc. Okay, so we disclose either on the face of the financial statements or in the notes. Present, bottom of the income statement, disclose either the face or the notes. Now I got a really good example. Don't do any questions yet. Come back. Next video is going to give you a more detailed example. You're going to feel real confident about this, and then you can go practice it. All right, see you in a bit.